In the world of banking, solid numbers are always good to see. But every once in a while, a company makes a move that's about way more than just one quarter. So today, we're going to break down Fifth Third Bancorp's Q4 earnings, where a really strong performance was completely overshadowed by one massive, game-changing deal. Okay, so let's start with the headline numbers. Fifth Third posted adjusted earnings of $1.08 per share. Now, on its own, that's a solid number. But what really matters is that it beat Wall Street's forecast by a healthy 8 cents. That's a clear signal to the market that their core business is running strong.
But you know what? As strong as those numbers are, they're really just the opening act. The real story here isn't about the last 3 months. It's about a huge strategic power play that is going to redefine this bank for the next decade.
And here it is. This is the real headline. Fifth Third has officially gotten the final green light for its massive merger with Comerica. This isn't just a proposal anymore. It is a reality. All the hurdles are cleared. They've jumped through every regulatory hoop, and the shareholders have given their approval, by overwhelming margins, by the way. So the deal is officially set to close on February 1st, and that is going to kick off a brand new era. But to really get why this deal is so powerful, you have to understand that they're making it from a position of incredible strength. Okay, this is not a rescue mission, it's a strategic acceleration. Let's take a quick look at how Fifth Third was doing all on its own. And it wasn't just about profit either. The bank also beat on revenue, bringing in $2.35 billion. This just proves that their core business, the day-to-day work of banking, was absolutely firing on all cylinders long before this merger was finalized. Now, here's a number that really makes investors sit up and pay attention: a 21% year-over-year jump in tangible book value per share. Just think of that as the bank's actual net worth if it sold off all its physical assets. It's a core measure of real value, and to see it grow that fast, well, that's just exceptional. And you can see just how healthy the business is across the board. Take a look. Their credit quality is the best it's been in almost 2 years, which means they're making smart loans. Their capital buffer, their safety net, is even stronger. They're consistently adding new customers, and they're running more efficiently. This is the solid foundation they're building this whole merger on. So with that foundation of strength set, let's turn to the merger itself. Because this is where the story shifts from just a strong quarter to a complete strategic transformation. The key word you always hear in a merger is synergies. And it's basically the corporate version of 1 + 1 = 3. It's all about the value you create by combining forces to save money and generate growth in ways neither company could do on its own. All right, first up, the cost savings. By combining all the back office stuff, merging their tech platforms, and getting rid of redundant roles, the new, bigger bank expects to cut an incredible $850 million in expenses every single year once it's all integrated. But hey, it's not just about cutting costs. It's about growth, too. The bank is targeting an extra $500 million in new revenue over the next 5 years. So, how are they going to do it? Well, the plan is to combine their strengths and sell more products to a much wider customer base. So, how exactly are they planning to hit that $500 million target? Well, CEO Tim Spence laid out this really clear 4-part playbook. First, they're going to scale up Comerica's expertise in business banking. Second, they'll focus on deepening relationships with their current clients. Third, a massive retail expansion in Texas. And finally, creating a powerful new division that's totally focused on the innovation economy. With the deal closing in just days, the focus shifts completely from planning to execution. The blueprint is there. Now the clock starts ticking on actually building this new bank of the future. And they have set a really aggressive timeline to make it all happen. The legal close is just the beginning. They've actually moved up the critical systems conversion, that's the technical moment when all the accounts and data become one, to Labor Day of this year. That is incredibly fast, and it means we should get a really clean, clear look at the combined company's performance by the end of 2026. You can really see the geographic and strategic transformation right here. Fifth Third is evolving from being a strong regional player, deep roots in the Midwest and Southeast, into a totally new kind of national powerhouse. It's adding critical growth markets like Texas and California, and it's gaining a top-tier specialty in the innovation economy. The CEO himself pointed out where he sees the biggest upside by combining Fifth Third's modern financial technology with Comerica's deep roots in venture capital and life sciences. He believes they can tap directly into the key drivers of the American economy. As he put it, this is their blue sky opportunity. Okay, so let's pull all these pieces together.
When you step back and you look at the big picture, what's the real takeaway from this massive move? Why does this matter?
This isn't just about one bank buying another just to get bigger. No, this is a calculated strategic pivot. They're using a strong financial foundation to build scale, push into high-growth markets like Texas, and specifically target the industries of the future.
And this bold move, well, it raises a fundamental question for the entire banking industry. Is the old model of being either a regional player or a coast-to-coast giant, is that obsolete? Could the new playbook for winning in American banking be this hybrid model, combining deep regional strength with highly targeted, high-growth national platforms? Fifth Third is betting its future that the answer is yes.